Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, and for the two of us, Happy New Year.
Well, thank you, Jim, and Happy New Year back to you and to your listeners as well.
Victor, the U.S. and China signed the so-called Phase 1 trade deal Wednesday at the White House. How did the markets react to that?
You know, it was a pretty subdued reaction, really. It's one of those things that was very, very expected. The things that move markets are unexpected things, and we can get into that as we go through this interview. The stock market, has sort of took it in stride, and today, the day following, stock markets are higher. Interesting, the soybean market wasn't impressed. It may have been more of a case of buy the rumor, sell the news. The soybean market fell. I mean, it didn't fall out of bed, but it fell back down to, say, where we were about a month ago on the news. So the soybean folks weren't super impressed with, China's going to come and buy everything that's not nailed down. Over the past year or so, the headlines on the trade war have moved markets. And I say trade war, right? That's so yesterday to say that. We're all buds now. But I'm going to expect as we go forward, we'll have more headlines on how Phase 2 is going or not going, and that'll move markets. But for right now, it's yesterday's news.
The major American stock markets and a lot of other countries' stock markets had a great year last year and seem to be off to a strong start this year. Do you think the stock market will keep going up?
Yes and no. Next question. It is, Jimmy, I got to tell you, the stock market does seem overvalued here. I have to be so careful with what I read because I read a lot of research, and certainly a lot of the people that I read are skeptical, to say the least, of the stock market. But there's an old saw I'd credit this with Bill Fleckenstein told me once, that markets that are overvalued can get way, way, way more overvalued. It doesn't have to make any sense to you. I think that's a good thing to keep in mind. The path of least resistance has certainly been up. The S&P 500, that sort of the benchmark, has been up 12 of the last 14 weeks, and the weeks that they were down, those 2 weeks, they weren't down much. And by the way, that 14 weeks or so going back to, say, October, kind of coincides with what we've seen, a real increase in the balance sheet of the Federal Reserve. There's folks out there that are crediting the rally in stocks with the liquidity, the flush or the flood of capital that the central bank has put into the market. I think there is a risk if you just step in here and buy the market. But look at it also this way. I think there is career risk for money managers who don't buy the market or who are not long here. I saw an anecdote the other day that people were firing money managers who had only managed to make 12 or 15% in the last year. That wasn't good enough. Gee whiz, with the benchmark indices up 30%, you got to be a pretty deadbeat money manager, right, to only have made 15%. Seems like that kind of psychology is going to come back and bite you, and maybe bite you hard. And I pay a lot of attention to psychology, but right now it's very bullish. There is this FOMO thing, the fear of missing out. I think that is very strong. I think there is the greater fool theory, where you're buying something just thinking that somebody that's even more foolish than you will come along and take it off your hands at a higher price. The greater fool theory probably was rampant in the late 1999 .com era. It was rampant when interest rates were going increasingly negative in Europe, and people were buying bonds that were guaranteed to lose you money, feeling as though they could sell them to somebody that was even more foolish than them. Some of the other metrics that we see on the psychology side, the put-call ratio seems to be at a 20-year low. In other words, there's way more people are buying calls than buying puts. The CNN Fear and Greed Index is in the mid-90s. In other words, people are greedy. A concentration risk, I find this very interesting. The market capitalization of the top 5 stocks. Okay, so you add Apple and buddies into that list, but the market cap of the top 5 stocks as a percent of the total cap of the S&P is at an all-time high. I mean, we know this. The concentration of the market, or the market, is being pulled higher by basically a handful of stocks. Positioning risk, everybody and his dog is long. And there's a complacency, I think, that, that the Fed has your back, so any dip, you buy it. Apple, which I call the most important stock in the world, I mean, it's virtually gone parabolic. Apple, by the way, probably the most researched company in the world. It's a great company, no question about that. But, I mean, has there been that much change in the market, in terms of how many employees they have, how much money they're making, how many products they're selling, and so on, that would justify that the stock is, way more than doubled here in just a year, and has gone up even faster than that recently. So I think this market is really running on psychology. I think it very likely can go higher. But as our Bob Farrell, an old dog in the markets, used to be at Merrill Lynch years ago, and he had 10 rules. And one of them was that markets that go parabolic do not correct just by going sideways. I think we've got, sometime this year we're going to have to start to factor in some sort of an election risk in the United States. And I think one of the sleeping dogs out there at the moment might be, call it Iran risk. This market, the stock market, spiked down overnight on the evening of the January the 7th, West Coast time, on the news of the Iranians launching missiles from Iran into American bases in Iraq. And then, when it looked like that was that, the market just accelerated back out of those lows. Those lows, I think, are going to be really important. If the market does, for some reason, roll over here and take out those lows that we made on the 7th of January, that overnight low, then I think we'd be setting up for the market to go another 5 to 10% lower. And the reason for that is you have to ask yourself, given that that's as low as we got when it looked like we were just a step or two away from getting into a real serious shoot-'em-up with Iran, what would it take to get us to go lower than that? So there might be a real shift in psychology. So there, my short-term view is, I think the market's goofy, overvalued. I don't want to be a buyer. From time to time, I poke at it from the short side, and I'm very aware that this uptrend could just keep going up and the market could get way more overvalued.
We'll have more with Victor Adair right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, gold hit 6.5-year highs last week when Iran fired missiles at American bases in Iraq, but then quickly fell back when both the U.S. and Iraq both appeared to be de-escalating their tensions. Gold's currently around $1,550, up more than $200 from where it was a year ago. But where is it going to go from here?
Well, that's always the $64 question, and I guess the first question I'd fire back at you is, well, what's your time frame? Let's look at it like this. I think the reaction to the geopolitical event, that's what we call these things when, people look like they're going to start a fight. Gold has had reactions over the years, has had these spikes when there's something scary happen, and then the spike kind of reverts, unless, of course, there's reason for it. We just get deeper into a fight. But as I just talked about with the S&P, there was a pivot in the gold market. Now, whereas the S&P fell like a stone in the overnight market and then came jumping back, gold did the reverse. Leading up to that event on the 7th of January, evening time, West Coast time here, that attack by Iran, the gold market had run up about $125 in 9 days. And then in the last hour and a half of that rally, it was up $40 as the news of that attack hit the markets. And then in the next the next 24 hours or so, the gold price dropped about $70. So we had this pivot in gold, rushed up there on this incredible news, and then fell back, as you say, when the two belligerents seemed to be de-escalating. So this pivot point, and it's $1,613 basis the February gold, that's just a little above spot. That pivot point is a very important point in terms of looking at this market. In a way, it's going to keep a lid on prices. And let me just say it similar to what I said about the S&P. What would have to happen to get gold to race up through those levels that it reached when it looked like maybe we were going into World War III? Okay? So, and if something gets us there, you got to believe that if we go through that pivot level, we're probably going to keep going and maybe accelerating. So in a way, that pivot point, that 1316, or make it 1613, I should say, that level ought to keep a lid on prices here, and that may come into play in the gold market in the short term. We also saw, if I forget to mention it, we saw the similar pivots, not only in the S&P and the gold market, but also in crude oil and bonds. I think another way of looking at gold, a little longer term here, is that, we had a 5-year bear market in gold from the all-time highs that it hit back in 2011, down into sort of mid-2016. For the last couple of years, the market's kind of gone sideways. I think the key breakout happened at the end of May, beginning of June of 2019. Interest rates, as we went into the summer, were deeply negative, and that the relative negativity of interest rates, or low interest rates, I think has had a major impact on the gold market here for the past couple of years for sure. At that same time as we were in the summer of 2019, the global stack of negative yielding bonds was reaching an all-time high. Central banks were printing money and that sort of thing. And gold had a kind of a breakout, and we rallied up to the highs of September last year. Kind of went sideways to the lower, fell off maybe $100 or so at the most into the beginning of December, and then made these new highs. I think gold is very under-owned, and I think people, a lot of the folks, that own gold are not going to sell. I don't think you're going to see the Central Bank of China or Russia deciding that they're going to take a quick profit and sell their gold. So over the years, the sort of the supply-demand argument on gold, or there's just hasn't been much discussion about it, because there's just all the gold virtually that's ever been found, is accounted for. It's not like we lost a lot of it. So the supply-demand argument, folks didn't get into that. But I'm wondering now, when we're in an environment where the Federal Reserve is trying to create some inflation, as would be other central banks around the world. I think we're going to see fiscal stimulation as well as monetary stimulation, because the power of monetary stimulation seems to be fading away. And I think that's a good environment for gold, or a bullish environment for gold. And in a way, I think another aspect that we say vis-a-vis the stock market, I think people might be buying gold for safety and might see that the stock market here, even though it's rallying, is kind of maybe on its last legs or goofy overvalued, so you go into gold. And one of the things that makes me think that is what we call the open interest. That's the total size of the paper gold market in New York. And it's just been growing and growing and growing, and virtually making new all-time highs every day here since certainly the beginning of December. And I'm seeing, and by the way, that change in the open interest just continued to rise, even while gold was trending lower for about $100 from September into December. So I'm thinking that the folks that are in there are patient. They're not, day traders. They're taking some positions. So short term, my view then, to sum it up, short term, I think gold is at a risk of maybe settling back a little bit, because it had this run up, this spike, this pivot, and that might keep a lid on it, and, people might do some selling. But certainly medium term to longer term, I think gold's going higher.
We'll have more with Victor Adair right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, in recent interviews, you've told us there's a good chance the lows we saw in interest rates last September might be the lows for interest rates. Are you still thinking that way?
Yes, I am. Let me put it this way. Interest rates, let's talk in terms of bond yields. Bond yields got incredibly high, as did short-term paper, back in 1980, 81 under Volcker. We'd had a decade and more in the 70s where inflation was rising and rising, and the central bank in the States decided to sort of break the back of inflation by raising interest rates. At least, that was the narrative at the time. So from the 1980 to 81 period, interest rates fell. So we've had like a 38, 39-year bull market in the value or the prices of bonds. And now with bonds rising the way they did, yields falling the way they did, interest rates got incredibly low last summer. I think some people would say they were at 5,000-year lows. I don't know. I know for sure if we use American data and British data, they were at least 300-year lows, and, that's long enough for me. I think part of that low rate that we got to was that the fear of inflation was gone. I mean, the rampant fear of inflation we had back in the 70s is something we just can't contemplate these days, it would seem. But, if there was a fear of inflation, there'd be a risk premium in the bond price that would help keep interest rates up. So that key turn date on or around the 3rd of September last year was the day when the U.S. long bond hit its lowest ever yield. And the all-time stack, as I call it, of negative yielding bonds reached its all-time high in excess of $17 trillion. That's negative yielding bonds around the world, mostly government, but some corporates. And in the month of August, the bond market had raced higher, and it almost looked like it was a throw-in-the-towel rally where anybody was short just got dragged out and shot. Also at that time, the yield curve had inverted, and there was talk, certainly loud talk in some circles, of an imminent recession, like the economic boom that the United States had gone on way too far, and we were about to fall into a recession, and gee whiz, you wanted to buy bonds and get out of stocks and get out of anything else. So since that key turn date, bond prices have trended lower. In other words, interest rates have been rising. Yield curves have normalized. The recession talk seems to have kind of gone away, but it's not like we got a rip-roaring boom going, that's for sure. The economies around the world look sluggish at best, I guess. So, the bullish case for bonds going higher or interest rates staying lower seems to be, they call it the 3 Ds: debt, demographics, and deflation. So that, like, in a way, with debt, it means there's just so much debt in the world that if interest rates rise, the cost of servicing that debt will strangle the economies, and interest rates will have to fall back down again. Demographics, everybody's the baby boomer crowd, everybody getting older, and they're going to be more careful with their money for sure. They want to be saving money rather than spending money, so that keeps inflation down. And then there's the deflation that comes from technology. Certainly these are, and to add to that, one of the things, been one of my favorite expressions, is that people, because interest rates are so low, have been reaching for yield. And what that would mean, let me make a little story out of it. You have somebody that's retired, they've saved some money, and they were planning on having an okay retirement, but they were also kind of planning on maybe getting 6 or 7% in interest on their money. Well, they can't do that, not with GICs, so they got to reach for something that's a little riskier, that's going to give them that kind of return that they think they need for their retirement. Well, this reach for yield is everywhere. I mean, it is everywhere. And I think it's distorted prices. And in a way, I'd say that the central banks are responsible for this. In a way, they say save Wall Street by getting interest rates low, but they've really punished Main Street, particularly savers, by having interest rates so low. But be that as it may, people vote with their feet, and they've been reaching for yield. Now, they've gone into the stock market. They've been rewarded. So there you go. The bearish case for bonds, one of them would be negative yields don't work. The central banks pushed interest rates really low, and it seemed as though you couldn't fix a debt problem by taking on or creating more and more and more debt. And I think there's an increasing line of thinking around that taking interest rates lower and lower, deeper in the negative ground, just isn't going to do the trick anymore. And I think that, in a way, therefore, without going on and on and on here, we're going to see inflation coming back. It's not going to come rip-roaring, I don't think, but I think where part of it's going to come from is that with the monetary stimulus not working so much, fiscal stimulus is that is government spending money. Where do they spend money? They're going to borrow money to spend it. Interest rates are low. We've already got high deficits. I think at some point the confidence in people who are buying paper is going to cause lenders to demand a worthwhile return on the money that they're lending out, and that can lead to higher interest rates. So I guess in my short-term view here, or longer-term view as well, I think interest rates can head higher. The risk in the short term, I think the real practical risk would be if for some reason the stock market rolls over and takes a slide, that the bond market will get bid and interest rates would fall. So longer term view, interest rates going higher, and also short term rate, but you got a risk on the short term here from if the stock market weakens.
You've been bullish on the U.S. dollar for a long time, but over the last few months it seems like you've been changing your mind a bit. A lot of people are forecasting that a weaker U.S. dollar will boost the commodity markets. What's your thoughts on that?
Well, I'd agree with that, and I understand that argument. I mean, I've been trading commodity markets for more than 40 years, and certainly we've seen some big cycles in the value of the U.S. dollar during that period of time. I mean, particularly back in Ronald Reagan's era. I have been bullish of the U.S. dollar. I think the U.S. dollar actually made its sort of penultimate low back in 2011. And in a way, that kind of begs the question of how do you measure the U.S. dollar? Because if it's the dollar against this currency or the dollar against that currency. There is a commonly known basket called the DXY. That's an index, but it's mostly composed of the major European currencies with about 10 or 12% of Japanese yen thrown in there and a couple of points of Canadian dollar. Another measure that I've found that's very interesting is the Federal Reserve of St. Louis has what they call a trade-weighted U.S. dollar index, and it's a broad index. It is weighted to the countries that the United States trades with. And I like it for a couple of reasons. It's a much broader index. Now, it's going to have components in there of China and Mexico, say, which are big trading partners with the United States. And the key thing to me about this index was that it had its all-time high, that's the U.S. dollar, all-time high against this basket of currencies, on the same day that the long-term interest rates turned back there at the beginning of September. Another reason I like this index is because it gives me a look at what I call the stealth strength or weakness of the U.S. dollar. So everybody that's looking at the currency market certainly looks at yen, pound, euro, that sort of thing. You see these major currencies, but, who knows what the Korean won is trading at, or the Indonesian rupiah, or the Brazilian real, or the South African rand. You're not the first things you look at. But some of these other currencies, as I say, also Chinese yuan and Mexican peso, are in this index. And this stealth strength or weakness of the U.S. dollar, to me, kind of foreshadows the movement in some of the major currencies from time to time. So one of my saws over the past couple of years that we've done these interviews is that capital comes to America for safety and opportunity. And believe me, it does. It's like a magnet. The United States is like a magnet. When the world is worried about things, the money will come there for safety. It'll also go to the yen, also go to the Swiss franc. And when the world is feeling frisky, willing to take on risk, capital goes out from the center to the emerging markets. So I think that continues, and it seems as though maybe since last fall, when the worries about recession kind of maybe frittered away a bit, that the U.S. dollar has been weakening across the board against some currencies more than others. I'm still a little, I'd say, for instance, I talked earlier about I think interest rates are going higher. Yeah, for sure. The U.S. dollar, I just don't have the same level of conviction as to which way it can go. I could certainly see capital coming to the United States dollar if the world gets worried about things. And another thing that maybe makes it difficult for me to really have a high conviction here is that the volatility in the foreign exchange market has been, for the past few months at least, extremely low. Like the market is dead in the water. And over the years, I've seen trends in currency markets go way further than you'd think it makes any sense, and then they kind of turn on a dime and go the other way. Right now, we're kind of in that opposite of that environment. Like we're not going anywhere, relative to some of the big moves we've seen in the past. There is a thing that the Economist magazine puts out called the Big Mac Index. How much does a hamburger cost in the United States relative to what it costs in other parts of the world, and a special hamburger, the Big Mac. And that index, it's a bit of a tongue-in-cheek thing, but at the same time, it shows that the most overvalued currency in the world against the U.S. dollar is the Swiss franc. And then there's a whole group of currencies that are about 25% undervalued according to this index, and these would be Euro area currencies, the Aussie, the New Zealand, Singapore, that sort of thing. Canada, just about 8% undervalued. So to wrap it up, I guess my view on the currencies is right now it's a confidence thing more than anything. If the markets are feeling in a risk-on, frisky kind of mood, then I think the U.S. dollar softens. If the world gets a little scared, I think they're going to buy U.S. dollars, yen, Swiss, and in this market probably also gold.
The Canadian dollar spent most of last year stuck between 75 and 77 cents. Do you think it's going to stay in that narrow range, or it's going to break out one way or the other?
Well, Canadian has been, the currency has been so dull. It did end last year, 2019, at a 14-month high, but the volume of trading at the very end of the year is probably the thinnest trading we see all year, so it's a little suspect. I kind of think that price action that happens in a real low volatility environment is just naturally going to be a little suspect. If you look at it the other way around, if you've got some price action and it happens on huge volume, then you say that's more real. So there's that. The U.S. dollar was drifting down at the end of last year, so that's one of the components that helps Canada. I'm a little suspicious of Canada, I guess. I think one of our sore thumbs is the huge level of household debt that we have in this country, just even relative to the United States. I think that is something that people from an international point of view, and they're looking at to put money here, put money there, pay attention to things like that. So I think that's going to be a drag on Canada. Canada was in a really narrow range this past year, as you say, basically a 2-cent range. The Federal Reserve cut interest rates 3 times. Bank of Canada did nothing. So our interest rate spread kind of worked in Canada's favor, but that didn't really show up on the cross rate. Commodities, in a way, broadly sideways, although commodities in the last 3 months of the year, when I say commodities, let's say, crude is especially important there, but just the CRB index of commodities was a lot of them. I'm going to say this to you again, that key turn date we had beginning of September, a lot of commodities turned on that date, and other than gold and silver, which traded lower, a lot of the commodities traded higher, and I think that helped Canada. So it helped us get into, as I said, that 14-month high at the end of the year. You can't talk about crude in Canada without looking at the discount we have on Western Canada Select. Right now, I think the discount's running around $24, and that's a big discount. So don't get fooled if you look at the WTI price and say, gee, it's trading higher, so that ought to be good for Canada. So bottom line, I guess I'm inclined to be bearish on Canada, but it's going to be very dependent on the ups and downs of the U.S. dollar, and I'm just got through saying I don't have a real high conviction on the U.S. dollar. So I don't have a strong opinion on Canada, but I'm certainly leaning bearish. But if for some reason, the U.S. dollar was to really start to fall, then Canada's going to follow the other currencies and go up.
Crude prices quickly spiked and quickly fell back down again when Saudi oil processing plants were attacked last fall. They did much the same thing over the latest Iran missile attack on American bases. When you look back over the past year, we saw oil trading around, $52, $62. What would it take for crude oil to have a sustained move above last year's high?
Well, let's say last year's highs, so let's say a move above $62, $65. What would that take? The reaction to those two geopolitical crises, these are those polite terms we use, the attacks in the oil facilities in Saudi and the attack from Iran on the American bases in Iraq, they spark that quick rise as people fear that all hell's breaking loose, and then, they fall back when there's no follow-through. I think those flare-ups have had to put some level of a risk premium into crude. I can't say, how much. But I'll come to answering your question this way, and I know I've talked about this before, but the market has been particularly focused on supply issues when they look at crude. And supply is the cutbacks from OPEC and friends, as they call it, sanctions on Iran, struggles in Venezuela. Their production's way down from what it used to be. And then on the other side, rising American production. This past week, American production was pegged at 13 million barrels a day. That's an all-time record high. U.S. exports are rising. Canadian production is rising. But I think maybe the key to getting crude oil to have a sustained rise would be looking at the demand side of the equation. Last summer, it looked like there was a recession coming, and if indeed we were to have a recession, that would probably lower demand. And now maybe it looks as though the worries about recession are kind of dampened down, so maybe we'll see some incremental increase in the demand side. But let me go to this from a longer-term perspective, again, my sense is that over the past few years, the CapEx, the money spent on finding new oil deposits, has been lower than it needed to be, so that I call it an inventory sales ratio is going down because of this lack of spending to discover new oil. One of the old sayings is the best fertilizer for low prices is higher prices. So I should say the best. I got that mixed up. We have a low prices. The best fertilizer for that would be higher demand. So that might pick up the demand side, and I think that's what it would take to get a sustained move above say their highs that we saw this past year. Now, clearly that the Iran risk that I talked about, if things do heat up in the Middle East there, and there's some concern about supply over there, that could sustain us above the last year's high. But I think to be truly sustained, it's going to take a pickup in demand and/or a sense that demand is really rising. Now, there's another thing, and this is maybe an even bigger picture, but I've been paying attention to this. We've seen trends in what they call ESG. This is environmental, governmental, and what's the S? The sense of being environmentally correct. Because of that, I'm seeing that there are pools of capital that have decided to not invest in the energy sector. They call it, they want to be fossil free, or they want to be away from investing in carbon. And it might just possibly mean that there's going to be less money available to the energy sector to go out and look for new petroleum deposits, and that money might get shuffled over to wind and solar and other forms of energy. I'm not sure, but I just think there's a possibility that could be a cutback on capital available to the energy companies at a time when demand is rising. So you could see the price of oil going up because it's being used, but the price of the oil and gas finding companies, producing companies, delivering companies, not going up. So, right at the short term here, to wrap it up, I kind of see support here around $58. And, just like with gold, I see the people that are long in the crude oil market seem to be patient with their positions. So, maybe that's a good floor for a short-term trade.
Victor, I guess from the perspective of more than 40 years of trading, you've written a post on polarfuturesgroup.com that expects big moves in the market this year. Why the moves, and what do you plan to do about it?
Yeah, that's I wrote that a couple of times, that I'm just really excited, probably more excited than I've been in my career when I look forward. I just think that there's a real good possibility that we're going to get some big moves in the market. And one of maybe the best reason for that is to say, because we've got so many things that are kind of at extremes right now. For instance, we've got stocks at all-time highs. Let's call it that. We got some parabolic charts out there in stocks. We got interest rates at all-time lows. We got debt levels at all-time highs. Then there's this thing about income inequality, and the social uprisings that we're seeing in different places around the world. There's like a social impact on that. Commodities are extremely cheap relative to stocks. Volatility is extremely low. That's like this complacency that's out there. We've got U.S. fiscal deficits now, routinely it seems, going to run through $1 trillion a year, and this is in a growing economy. We've got unemployment at 50-year lows in the United States, down around 3.5%, but wage growth is flat. There's junk bond yields are extremely low relative to treasuries. People, there's so much money out there searching for yield that people will throw money at some, call it more risky investment than treasuries for very little pickup in yield. We've got an economic expansion in the United States that's been going on, I think it's the longest ever now, since 2009. pension crisis, and then these little geopolitical spikes. We've got the U.S. election coming up. So how it feels to me is that despite this complacency that seems to be registered in the market we just chug a little higher every day in the stock market, volatility is low, that's what I mean by this complacency. It still feels to me that these markets are really fragile, and these extremes that we've got all over the place would lead to reversals. As I said earlier about Bob Farrell, when markets have had a really steep move one way or the other, they don't correct just by going sideways. So I think the stage is kind of set for some big moves, and I'm not going to pretend. I'm just, what could I say? I'm just too experienced to say I know what's going to happen. I have no idea. But I can tell you, it smells to me like we're going to get some big moves, and I'm sort of sitting on the edge of my chair, want to get there. I think the tricky thing will be if these moves start to happen, and given that things have been so kind of complacent and dull recently, that it might be very difficult to sort of stay with some of the moves. Now, let me leave you with one thing here from Bill Fleckenstein. He's a money manager, newsletter writer down in Seattle. Used to be a money manager, I should say. Now just writes a letter. And he was on Real Vision last week, and he always has some really interesting things to say. And I'm going to have to paraphrase him here because I didn't write it down exactly. But he was saying that, research really matters, but the tactics that you use around the research is where you make your money. So what that means to me in my language is that what you do with a trade or an investment once you have it on is way more important than what got you into the trade in the first place.
Victor, thank you so much for being on the show.
Jim, it's always a pleasure to talk with you. It really is. Thank you very much.
My guest has been Victor Adair, Senior Vice President of PI Financial in Vancouver. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.